Hello, everybody, and welcome to another episode of Real Talk. I'm your host, Stephen Meade. I'm the broker owner here at Domicile Real Estate. We are a real estate brokerage located in Long Beach, California. We service Los Angeles and Orange County. So if you are looking to buy or sell a home, especially if you are a first-time home buyer or you love architectural homes or have an architectural home, absolutely reach out to us. So this week we're going to talk about something that really has kind of been all over the internet in advertisements, and that is something called Buydowns. And Buydowns used to have another name. So we used to call these graduated payment mortgages. And sometimes these can be a really good deal for the right buyer in the right situation. And so there's just a couple things that we thought we'd share that you need to know about these things before considering this. A buy down or a graduated payment mortgage, basically what it does is it means that if the market interest rate is 6%, in a 3-2-1 buy down, the first year, that 6% mortgage will only be 3%. The second year, it will be 4%. The third year, it will be 5%. And then the fourth through 30th years, it will be that 6% number. So this is a great option. For example, really there's two conditions. One is that you think your income will rise in the next 3 years. So this is especially true for first-time home buyers who might be earlier on in their careers or who are expecting increases in their income. The second condition is that you want to make sure this is going to be a loan, a house that you stay in for 3 years, right? Because if you don't stay in for 3 years, you're not going to get the whole benefit of that. Now, one of the things about these buy downs and these graduated payment mortgages is that some lenders are pricing them very aggressively right now. And so, for example, in a 3-2-1 buy down, which is what we just talked about, that's 3% off the first year, 2% off the second year, and then 1% off the third year. That's really like saving 6% on the interest, we'll say, to keep the math easy. But lenders are only charging 4.5% for that privilege. So if you know you're going to keep that for 3 years, it might be worth it. The other little caveat of these graduated payment mortgages is that they cannot be paid for by the buyer. They must be paid for by the seller. So obviously, if this is a home that you're interested in that has 10 offers on it, getting it paid for by the seller is probably not going to happen. They also make a 2-1 buy down. And that, as you might imagine, is where the first year the loan is 2% less. And then the second year it's 1% less. And then it goes to its original rate for the remainder of the loan. And those 2-1 buy downs, which save you 3% on interest over those 2 years, those typically cost a little over 2% of the loan amount upfront. And again, it's the same rule. Only sellers can actually provide that for you. Now, when are these a bad idea? And why are lenders pricing these aggressively? If you're the kind of person like me who asks, why are these a good deal right now? Well, a lot of it depends on what lenders think. And whenever a lender is giving you savings over 3 years and they are pricing it less than those savings, what does that mean? Well, it means that the lenders expect on average that people will not keep that 30-year fixed rate for 3 years. Now, why would a lender assume that someone won't keep that loan for 3 years? Well, the number one reason is that they assume that at some point in the next 3 years, rates will be lower than they are today, and the person who is paid for that buy down may elect to refinance that loan before the end of the term. So what it means is that lenders have an expectation that rates will be lower than they are today at some point over the next 3 years. So definitely bear that in mind. But this is a great way to greatly reduce the monthly payment to get into a house. It can extend your buying power, your comfort level, and it's especially suited for people who think they may have a situation where they are running into higher income down the line and they can take care of that higher payment level. As always, like a lot of things, these aren't necessarily good or bad. It really depends on your individual situation. Also, we are going to be doing a webinar on ways to increase your buying power and reduce your payments in this era of higher prices and higher interest rates. So definitely keep an eye out on that. We're going to do a couple ads and promotions for that. We'll probably add it into the comments on these videos where you can sign up for that webinar, but expect that to come in the next 2 weeks. It'll be a 30-minute webinar, so not a long time, but really a great opportunity and a great chance for you to be able to learn how to maybe extend your buying power and be open to some options that you weren't aware existed or really weren't considering. Anyhow, thank you so much for watching. Questions and comments, as always, we love them. Again, if you are looking to buy or sell a home in Los Angeles, Orange counties, and you'd love to learn from our expertise and you have questions, absolutely reach out to us. Don't forget to like, subscribe, and hit that notification bell, and we will see you again real soon.